Good evening, everyone. Welcome to the channel. Today I am going to talk about Shineway Pharm interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. China Shineway Pharmaceutical Group Limited offers a diverse range of businesses and services, including research and development of Chinese pharmaceutical products, manufacture of various types of medications, such as plus injection, plus soft capsules, plus granules, plus tablets, plus pills, plus oral liquid, plus powder trade of traditional Chinese medicine granules in multiple therapeutic areas, including plus respiratory system disease, plus nervous system, plus digestive system disease, plus cardiovascular and cerebrovascular, plus orthopedics, plus pediatrics, plus other areas medication for strengthening the body trading of agricultural products. Shineway Pharm's stock price has not shown a significant increase in the past year, despite a modest 8.6% gain, including dividends, for shareholders over the last year. The company has faced challenges that have impacted its financial performance. A decline in revenue and net earnings was reported in 2024, with further projections of decreases in 2025 due to government procurement, office tenders, and anti-corruption measures affecting the traditional Chinese medicine industry. These factors have contributed to a disappointing period for the company, resulting in an 8% fall in shares. The primary drivers of revenue growth or decline are largely influenced by market trends and product performance. On one hand, the decline in revenue is attributed to a decrease in sales of prescription medications, particularly Qing Kai Ling injection and Shen Mai injection, as well as OTC medications and TCM formula granules. This can be linked to factors such as shrinking demand, consumption downgrading, and stricter cost controls under medical insurance policies. On the other hand, certain products have shown growth, including Dandangtong Now soft capsules, Zhangzhaitong Luo soft capsule, and Shujintong Luo granule. These products have seen significant increases in sales, indicating a shift towards more popular and in-demand items. The stability of oral products, which account for 65.8% of total sales, also suggests that this segment is less affected by market fluctuations. Overall, the revenue growth or decline is driven by a combination of product performance and market trends. Net income and profit margins. A shift in performance in recent financial reports. A notable shift has occurred in the company's net income and profit margins. Despite a decrease in net income by 1.9% to RMB 614,663,000, the net profit margin has increased from 30% to 37.2%. This paradoxical change can be attributed to a combination of factors. The gross profit margin has decreased from 75.3% to 72.2%, indicating that the company is struggling to maintain its pricing power and efficiency in production. However, this decline has been offset by a significant decrease in turnover by 20.8%. This suggests that while sales have declined, the company's ability to generate profits from each sale has improved. The sales of specific product categories have also decreased, contributing to the overall decline in net income. Nevertheless, the increase in net profit margin is a positive sign, indicating that the company is becoming more efficient in its operations and better at managing costs. The company is indeed generating positive operating cash flow. This is evident from the consistent increase in net cash from operating activities over the past year. Specifically, there was a slight increase of 0.4% compared to the corresponding period and the first half of last year. Furthermore, the company's bank balances and cash as at June 30, 2025, showed an increase of RMB 720,666,000 from December 31, 2024, indicating a steady growth in its financial resources. This positive trend suggests that the company is managing its finances effectively and generating sufficient operating cash flow to support its operations. The company's financial summary reveals a decrease in bank borrowings by RMB 523,000 from RMB 330 million to RMB 328,477,000. Additionally, interest expenses on lease liabilities have decreased for both subsidiaries. However, these changes do not indicate a significant shift in the company's overall debt level or interest expenses. Management's outlook on company strategy. The company's management emphasizes its commitment to producing high-quality modern Chinese medicine products with good efficacy. They also plan to invest in research activities and expand into relevant regions in China through government-funded enterprise development funds. However, no specific strategy or outlook for the company is mentioned. The company's financial summary reveals that it has a history of paying dividends to its shareholders. This is evident from the references made on pages 35 and 36, indicating a commitment to returning value to investors through dividend payments. However, there is no information provided regarding share buybacks, suggesting that this strategy may not be part of the company's current financial plans. Concerns about inventory buildup and supply chain disruption. There are valid concerns about inventory buildup within the company. The data suggests that inventories have not been decreasing as expected, with a notable increase in finished goods turnover days. Specifically, the inventories balance has decreased by only 11.2%, indicating that stock levels remain high. Furthermore, the turnaround time for finished goods has increased to 110 days, up from 98 days previously. These metrics indicate potential issues with inventory management and supply chain efficiency, warranting further investigation and action to mitigate these risks. That concludes the financial summary for Shineway Pharm. Feel free to comment below, and I will be happy to answer them when possible.